Imagine a scenario where you can only pick one indicator for the next year to use on your charts. What would it be? Hey guys, warm welcome to you. All right, so they're a channel sponsor, guys. If you want to check them out and you're looking for a new broker, go and check them out. It's the link in the description below. I know many of you already have. I'm very, very happy with the service they're offering and enjoying the CTrader platform. Actually, you can use MT4 as well, but I know a lot of you have switched to CTrader and kind of like it. So I'm in the CTrader platform. Imagine a scenario where the government has mandated, what a surprise. We feel like we've got a lot of restrictions on us at the moment, don't we? But let's imagine this scenario. The government has said, well, you, Mr. Trader, are no longer allowed to use all your indicators. We have decided, using data and science, that you should only have one indicator on your chart. So you must pick your one indicator by the end of the year, and that will be your sole indicator until 2021. And you will be fined if you put a second indicator on your chart. You'll be fined again anyway, you get the idea, guys. Right, so this analogy is, or this scenario, should I say, I hope it doesn't ever come, obviously, who knows with the government, but you've got one indicator. You're only allowed one indicator. And I know this is a bit of a, a bit of an interesting scenario, but it's not a bad thing to think about from an operational perspective. If you're using lots of indicators on your chart, you could say you've got too many. So thinking about this and saying, okay, you're only allowed to use one, what would it be? So the obvious kind of way we look at this is go, okay, let's have a look at the market we're trading. So imagine you're trading currency pair, any major currency pairs. You've got a couple of options. Do you go the traditional moving average route and go pick a moving average? We'll talk about which ones maybe use in a moment. Or could you go with a bollinger band or a keltner or stochastic? What would you use? Now, assuming as well, the legislation has come out and they've amended this and said you can't have anything volume related. So no volume, you can't have anything derived from volume. It's price derived only. So your job really is to have a guess as to what the conditions are going to be like next year. Because as we know, guys, if you're using the right indicator for the job, you're going to have much more success from it. If you're in a trending market, a moving average is going to work out quite nicely. Pullbacks to the moving average, nice. If you're in an oscillator, if you're using like an oscillator, not going to be so good because it's going to be overbought or oversold for a long period of time. You might get one signal every now and then as it rotates off the overbought or oversold, and then you take that trade. So you've kind of got to have a little bit of a think about, well, where do I think price is going? What do I think it's going to do? And that's going to be something you've got to suggest and decide. Now, if you look at the yen chart here, USD JPY daily, it's range bound. You could argue that we're in a downtrend here, and maybe your thesis is, well, actually, we're going to break the lows and we'll become more trending. So anyway, regardless of what you're trading, you're kind of trying to think of the conditions you're in. And then you go, right, well, what can I trade? What can I have? Your first port of call is going to be, I would guess, and let me know, guys, what your number one indicator would be, because you guys probably have some other ones that I've definitely I haven't covered. Your first port of call is going to be a moving average, right? You're going to say, okay, what about moving average? But then you say, well, what kind of length do I use? What sort of period do I use? And we know if you've got a 5, very, very tight, very aggressive, great for really trending, aggressive environments, good breakouts, good for kind of tiny little pullbacks, superb for that. But how useful is that really going to be? How many times do we get that as a general condition in the markets? Almost none. So probably not going to be 5, 10, maybe 20. 20 becomes a little bit more valuable. 50, 100, well, you're going to be so far away from 100 or 200 or 50 potentially that, again, isn't going to have any use. So maybe you use a 20 period. But then the other argument to that is, well, maybe I don't use a 20 period because actually I can have a good idea where price is most of the time. But I'd suggest that that's probably not a bad one to have. Think about having a 20 period moving average. You can use that on multiple time frames. It works well for kind of first pullback type trades. It works well for mean reversion around a moving average. I guess an argument could say, well, if I'm allowed a moving average, surely I'm allowed a Bollinger Band, right? It's one indicator, even though I've got a standard deviation wrapper around a moving average. Same with a keltner. Yeah, I guess you could, and probably you would. You'd be like, well, if I'm using moving average, may as well have a Bollinger Band. But the thing with moving average is that it's quite valuable in most environments, and it also acts as a good filter. So if price is kind of oscillating around the 20 moving average and hasn't really broken out either way, you might not want to get involved. If price is nice move away from the moving average, again, let's forget about Bollinger Bands for now, then you say, okay, well, if I'm range bound environment, that's a good mean reversion type trade, look for a reversal back to the moving average. If my trending environment, then I'm going to wait for a pullback to the moving average for a continuation type trade. So pretty good. I'd say that's a high contender. Let's have a think about maybe one of the oscillators. So one of the oscillators, let's be honest, guys, RSI, CCI, stochastics, they're all pretty much of a muchness. You know, they're all pretty similar. And this is even the standard settings here. They're not bad because in a range-bound environment, you're going to get lots of signals. You're selling on overbought curling down, you're buying on oversold curling up. Range-bound environment, it's a textbook type thing. When it starts to trend, not so useful. However, when you get that first overbought or first oversold, then you could pull the trigger on it. Then you've got one. So that's not a bad way of looking at it. However, I might suggest to you that you can probably, when you look at price, get a good idea what your stochastics is going to do. Because stochastics is literally saying, where are we based on the range in a rough kind of format. Let's look at the last range for the last X days. Where's price position? If price position is right at the lower end of the range for the last X days that you've got in the oscillator, you're going to be oversold condition. If it's on the high end, you're going to be overbought, and somewhere in the middle. So you can kind of get a feel for where your oscillator is going to be. So that's not a bad one. I think one that also is another contender, guys, would be one of my very, very favorites, average true range. Now, again, I hear you going groaning and going, oh, Mark, there's an awful choice. I can get the range approximately from this. I know. You can get the range and you can kind of see and go, hey, average range is high. All it's doing is taking high minus low. Is it a waste of your indicator credit? Yeah, I get it. Could be considered that. But again, all indicators are derived from price anyway. However, with average true range, there's a lot of things we can do. We can use, and this is kind of, I guess, the point, guys, of this video, is to think about using indicators not necessarily as triggers, but as filters to stop you getting involved when markets aren't really in your correct environment. So in the ATR, when the range is low, not what's going on, you probably don't want to get involved in it. When it's high and it's starting to move more aggressively, or if you see a large ATR suddenly break out, you might want to get involved in it. That might be something you want to get involved in. It might be something you want to look at. It acts as a good filter. It also acts as a good place to put your stops. You go, hey, what's the current ATR running at? Right, it's running at whatever time frame we're trading. It's running at 50 pips. That's my stop. It's good for running for a kind of coming up with price targets. If I'm on a day trade, I'm not going to be looking for like 2 ATRs. I'm looking for maybe 1 ATR or half an ATR. So it's got multiple different uses. So we've got moving average, we've got a stochastic, we've got an ATR. I think those are the top 3. What do you think, guys? Let me know what you would pick. I'm just seeing if I notice anything that stands out. These are all, very, very similar. Exponential moving average is the same kind of thing. I guess you could cheat with some sort of rainbow moving average or triple moving average. I think those are your main contenders. There are different flavors of them, and this is where you can come in and say, hey, I think actually you could use this, which is a function of ATR, which is far more useful. This is not a kind of exercise in loading your chart with indicators. It's in fact the opposite. It's thinking about, and yes, I kind of talk about this in a little bit of humor, but there's a serious side to it, thinking about stripping back things that have no use to you, stripping back things that are adding more noise. Because even though you think you're not getting signals and you're not being influenced by an indicator you're not looking at, the very fact that it's on your chart, the very fact you see that overbought stochastic might make you not buy. But if you're in a trending environment, you're about to break out, it's very, very strong, that's the time you want to ignore the stochastic. Same with the moving average, like it's pulling back to the moving average. I maybe should be careful, but in range-bound environment, the likelihood is it overtakes and goes round the moving average as mean. So it's really an exercise, guys, in thinking about what you've got on your chart, thinking about how you use the indicator and how you can more utilize or maximize the value of that indicator in different environments. When it works awfully and when you know to just get rid of it, when it works well, and when you can use it as a filter. And check them out. There's a link to them in the description below. And while you're down there, let me know. You got one choice, one price derived indicator for the next year. What are you choosing? Bye bye.